What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market. After that, we've got our core list of companies, and if you stick with me towards the end of today's video, we've got 5 additional trade ideas to share with you, so definitely stay tuned for that. As always, anything that we are associated with is linked down below in the description, and without further ado, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we've got yet again another solid red-bodied bar here, but this time with a little bit more of an upper wick and a little bit more of a lower wick as compared to the previous weekly bar right there. All the upper wick would indicate is an absolute failure from the buyers to get any price acceptance within the prior week's range, and instead, we went back down through the opening print and the rest was really history. After FOMC, the sellers ran away with it. We've got a pretty weak close at the bottom end of the weekly range here, a little bit of a lower wick, but only being produced by the intraday rally on Friday's session there. We'll talk about that on the daily time frame in just a moment, but overall, the main characteristic that we're focusing on is the size of the large red body here, which of course has to strike me as bears being in control from that structural perspective. From a location standpoint, on the bar-to-bar count, we've got a significant lower high and a significant lower low. That, of course, also has to fall into the bear category. What's interesting, though, is the fact that we're coming into the 100% retracement and the June low of this move right here. So would it be reasonable to start looking for a little bit of a dead cat bounce? Absolutely, but please just don't forget the weekly trend is still firmly down. Let's talk about that now. All-time high, lower high, lower high, lower high. There was our miraculous double higher high, but instead it produced a lower high. This did not hold as a higher low from here to here, and now we're back down at the equal lows. Therefore, the trend is firmly down. And if we do bounce, anything that remains underneath 410 is just a lower high, and over the course of time, we will see if we can get trend continuation to the downside. So just be mindful, even if a dead cat bounce does happen, the trend is still firmly down. To reverse the weekly trend back to the upside, we would have to do one of two things. Number one, we'd have to take out 410, and that does not strike me as being a reasonable expectation into the upcoming week. Or number two would be producing a higher low and starting a new sequence to the upside. And obviously that would require more than one weekly bar, so that's not going to happen this upcoming week either. Therefore, all of the data we've seen thus far does point to bears being in control, with the caveat that we can see a dead cat bounce, but it will not change the trend. One thing that I also want to point out is this weekly 200 SMA, that's the green line hovering just underneath us. If we grab a little bit more time, let's go with like a 15-year chart. Notice that the weekly 200 SMA is fairly well respected, right? Support all the way off in the bottom left, then turning to resistance right there, then turning to resistance, support. So regardless of what side we're on, it does tend to have some pretty significant reactions around it. This, of course, is an anomaly because that is the sickness sell-off, where we just went right through it both ways, to the downside and then back to the upside, like a hot knife through butter. But this time around, we have not touched it in quite some time. The market conditions are slightly different. Are we going to produce some sort of reaction at the weekly 200 SMA? Maybe. I don't bring this up to guarantee that there's going to be a bounce off of it. I just want you to be aware that it's there, and in the past, it has historically been respected. So, something to bear in mind if we continue lower earlier on in the upcoming week's worth of trade. The next thing I want to point out, of course, is our high volume node. Here it is, and we know that we are firmly underneath it now, but I just wanted to point out that the upper wick of this past week's worth of trade did firmly confirm that as a resistance point, and obviously we've closed further and away from it. Remember that I don't show you this upcoming chart here to shock or scare you, but I'm just pointing out that the next major high volume node is like SPY 340. Notice that as we've breached and fallen underneath this, there is nothing but a low volume void until we get to the pre-sickness highs right here, roughly 340. Again, I'm not implying that we do this upcoming week. I'm just pointing out that the structure is fairly poor underneath us. So that's what I've got from the weekly perspective. Let's take a look at the daily now for some actionable setups into the upcoming week here. Let's throw our study set on, 50 SMA in blue, 200 SMA in green. The first thing that we should discuss is the weekly expected move. So 2 weeks in a row now, we've had a 2 sigma move to the downside. So, way inefficient of a options market pricing in these expected moves. And we did get an expansion of expected move this upcoming week, but I just want you to keep in mind that, remember, markets like to move from range compression to range expansion, back to compression, back to expansion, so on and so forth. So with 2 weeks of a 2 sigma move outside of the expectation, I would say that that is quite a bit of expansion. And we're also sitting on that June low roughly. So would it be out of the question to start to see a little bit of range compression and see the market do something like this? It's possible. I just want to bring it up as a possibility. I'm not saying it has to happen that way. I'm not saying we have to breach again. I'm just pointing out that the market has seen some significant expansion. Even though the expected move has gotten larger, we might actually see a week of compression. Just an idea, right? In terms of trend and what the expected move would imply, obviously a lower high if we make it to the top and a lower low if we make it to the bottom. Therefore, the daily downtrend will remain intact if we stay contained within the weekly expected move. A little piece of feedback that I got last time was to add in the actual price numbers. So the blue dotted line is the bottom and top of your weekly expected move here and there. Hopefully that's helpful. You can let me know in the comments if that is a plus or if this is looking too much like a rainbow. Anyways, in terms of levels, let's talk about what's going on here. Obviously, the main level in question is the June low. That's first and foremost. So what keeps this chart, optimally bearish for anyone looking for a breakdown? Well, number one, there was no gap fill whatsoever on the Friday session. It was just a gap and go, and then a little bit of a snapback into the afternoon, printing this daily hammer. But this gap is really, in my estimation, going to be the judge early on in the week on whether or not sellers will remain in control or we'll see a little bit of a snapback. If we fill the gap and reverse off of it, that is going to be optimally bearish. So anything really that remains underneath 373.45, bears are in control. If we start to get higher lows above that, then I would say the only time where we would flip back to being bullish, and this is really more than a dead cat bounce, is if we can see structure accept above 382.25. Why is that the number? Well, we had that very, very small pause, 3-day balance, and that's where the FOMC breakdown comes from. So if the market wants to do something like this, then maybe there's an opportunity for some sort of bullish structure to start to unfold. But as of right now, you can see that the odds would really start to favor sellers remaining in control. Even if we fill the gap and move a little bit higher, getting price acceptance above 382.25 is well outside of the weekly expected move. So it would not be my first thought or objective as we head into the upcoming week. So again, just to recap here, can we see a little bit of a dead cat bounce? Yes. If we close the gap and reverse off of it, bears firmly in control. I would look for a retest of the low of Friday, 364.35, and then possibly see continuation to the downside. Our levels are 357.85, weekly expected move low, 355.40, and then 350.65. If those numbers don't appear to be making any sense to you, let me grab a little bit more time and we can walk through where they're coming from. Of course, if I zoom in on this, there we go. It was your prior high from here before the pullback, and then also the double bottom, if you will, neckline, which broke and held on the retest right there. That's where the numbers are coming from. Hopefully nothing is a surprise. There are no questions about what I've just discussed. Everything should be pretty well explained at this point in time. So those are my expectations. Those are my thoughts for early on in the week. Yes, this is a hammer candle. Yes, we can see a dead cat bounce. Use this gap, please, to judge whether or not buyers or sellers are in control, and don't get even the slightest bullish unless we can get price acceptance above 382.25, which does seem like a bit of a stretch at this point in time. Let's look at the Fibonacci's from a couple of different perspectives. Number one, obviously, is if we do something like this, this goes without saying. Obviously, we've gotten the 100% retracement. That is pretty self-explanatory. Now, there's two down moves that I want us to focus on with the fibs as well. If we come in from here to the bottom, then what you'll notice is there's your FOMC breakdown. It's the 38.2. So even if we bounce, move to the top edge of the weekly expected move and consolidate underneath, that again is just an ideal lower high off of the dead cat bounce. The weekly trend remains down, bears in control, right? So that is one possibility. If we take a look from the high of the FOMC day to the bottom in here, now where does our 38.2 line up with? You can see it's the top of the gap, which is, again, if we fill the gap and reverse off of it, that is the optimally bearish outcome for early on in the upcoming week. And that's what I've got for you on our S&P itself. Let's take a look through some sectors now and see what's taking place out there in the sector world. Here we go. XLU is up first. Let's go ahead and drop this down to a more reasonable time frame. Let's go with like a yearly. Yeah, there we go. Now we're talking. All right, XLU back inside this gap from in here. It does strike me as being in a more healthy spot if the S&P were trying to find a bottom. But as of right now, the hammer candle would suggest, yes, there can be a bounce here. And of course, we're just looking for it to remain underneath 74 at this point in time. As long as the XLU remains underneath 74, then good. This is in a decent spot for if the S&P starts to turn around. As long as we're underneath 74, fine. Defensive sector is not leading the way. If it takes out 74, a little bit more of a red flag, but currently no issues with the XLU. Real estate, big new lower low. I would expect a little bit of snapback here because we've gone further than the 100% retracement. Usually we bounce off of the 100%, even if it's just for an intraday move. This got none of that. Just straight through, continuation. Now we've got a hammer candle at the lows off of prior support as well, around 37, mind you. So I would expect a little bit of a dead cat bounce, but really looking for a rejection off of these lows now, around 38.74. Of course, that's bearish for the S&Ps, but it's such a lightweight sector, it's not going to make or break us. Same thing with the XLB, through the 100% retracement without any sort of pause or anything at the lows. So I would expect a little bit of a snapback, then look for the lower high to be formed somewhere around 71, 71.15 in that general area. But again, lightweight sector, not going to make or break the S&Ps. Next up is the XLK. This will make or break the S&Ps because this is the heaviest weighted sector of them all. What you'll notice is we do have that 100% retracement, but we've got the hammer right at the 100% retracement. So can we see the dead cat bounce? Yes. Can we see a lower high? Yes. Will it preserve the daily downtrend? Yes. And if we reattempt 122.65, should we expect it to break? The answer is yes. So all of those things considered, I would watch out for early on in the week. If this rejects off of 126.85, that's the optimally bearish situation, right? Back testing this little range low, reject there for a lower high, and then we're back off to the races to the downside. If we get any acceptance in this range, I would at least be neutral and only flip bullish if the XLK can breach and get back above 132.25. It's going to take a lot of work for that to happen, but that's kind of the line in the sand, and hopefully that makes sense, because if we do something like that, we need to get back above that 61.8 and really just focus on that structure, right? It's not so much the exact level, but it's the structure that's important there. So XLK does strike me as being bearish. We have a couple of outcomes early in the week. I would look for the bounce, but watch the lower high off of either 126.87 or 129.42. Either of those levels could produce the reversal to the downside. Next up is the XLF. This has also come in for the 100% retracement. It's got a hammer candle from Friday. So can we see the bounce off of this level? It's possible. Could see a little bit of an oversold bounce here to close the overhead gap. So two things in the XLF. Obviously, this is the second heaviest weighted sector that we're watching. It's not by market cap, but in our lineup it is. So if we do get the dead cat bounce that closes the gap and reverses off of it, very bearish, stay away. You're not really looking for longs in that case. If we can get through the gap, then there's thin structure on the way down. I would watch for longs to retest 32.40, the breakdown from this area, prior support, prior rejection points as well, support in here, very historic level. So again, if we can close the gap and get a little bit of a move through it, that's where I would look for the longs through this thin structure to back test this. And when and if we get here, that's where you can position for new money shorts, right? You've got a lower high from here to here, and even if you wanted to count it from there to there, right? And it makes sense from a structural perspective. That's where you would scout for a short, XLF being the second heaviest weighted sector in our lineup. I would say that would be quite bearish for your S&P 500, but early in the week, yes, looking for a bounce. Next up, XLI, 7% of the S&P 500, just pointing out that we have a large gap unfilled underneath us. I know can't see it off to the left, that's why I made this yellow. We do have an overhead gap as well. All the same sentiment applies. More than 100% retracement, yes. Can we see the dead cat? Yes. Again, everything applies here. Line in the sand for a lower high would probably want to be underneath 88.21. So rally to that, look for the lower high, and then we're back off to the races to the downside, preserving this daily downtrend. If it's going to be bullish, it's got to be acceptance back above that 88.21. Next up, we've got the XLY, consumer discretionary, which is honestly holding on, it's holding in there, doing its job. So look at this, not the 100% retracement. Instead, the hammer candle is forming just barely underneath this prior breakout level. So I suppose if you really wanted to get nitpicky, you could say it's a 100% retracement of this move plus some, and now we can look for the dead cat. If this does happen in the XLY, I would watch for a backtest of the breakdown here. 153 is your number. If we remain underneath 153, I would have to be neutral here because we're still above the breakout level, the break and retest level from right around in here. If if we don't get into this area in the first place, if we just dribble down lower in this, choppy, neutral, not as bearish as everything else though, because clearly we're still above those June lows. So the XLY is an interesting display of relative strength here, and I think it's going to be something that helps guide our decisions going forward as and if the SPY itself starts to come into a bottom. So overall, watch this section, the main two levels, just to keep it simple, right? 153 on the upside, 147.85 on the downside. If we're underneath, bearish, inside neutral, upside bullish. Simple as that. Next up, XLC. It's off of a cliff. Hammer candle, yes. More than 100% retracement, yes. Absolutely. Dead cat, yes. But it's so bearish that, obviously, even if we were to rally into this 52, sure, there's a couple of deltas to pick up on the upside there, but it's just going to be, a lower high and then dribble back down lower. So I would not be overly bullish in the XLC until the structure starts to change here. I would not be fishing in the XLC for the dead cat bounce. I would look for where there's relative strength, aka the XLY, or even the XLF with that thin structure overhead, right? Next up is the XLP, consumer staples. This is D for defensive, so it's not the end of the world to see it off of the highs, but certainly don't want it making new lower lows underneath 68.63. So use that as a line in the sand. I would say as long as we're underneath 72, you're kind of bearish in this one because it's the neckline of what would have looked like a weekly head and shoulders, right? Kind of this ugly area right in there. So anything underneath 72, bearish. If we're in here, a little bit more neutral, and then bearish, certainly, like no doubt about it, bearish as long as we're underneath 70, 27, 25, right? Next up is the energy sector, falling off of a cliff. Again, decent from a risk on, risk off perspective. This is a risk off sector. It is D for defensive. To sort of see it so deep in this range is a good look. But remember, guys, please never forget this. Never, ever, ever forget this. Bearish pressure is still bearish pressure for the S&P 500. This could be a defensive sector. It could be a lightweight sector. But if it's moving down and as aggressively as energy did on Friday, it's still going to have some impact on the S&Ps, right? So that is bearish nonetheless. We're saying if the market starts to turn and these defensive sectors have now cooled off and they're not leading the charge, that is a little bit better of a scenario. So that's what I would say about the energy sector. Looks fine. No major concerns about it. And here we're concerned in the lightweight sectors if they start making new lower lows. So as long as this can contain itself within this range, okay. But if we start breaching 65.50 to the downside, concerning. Next up, XLV. Second heaviest weighted sector by market cap, third in our lineup, perhaps another really important sector to be mindful of here. One thing I would point out is that, we never really rallied for the pure backtest of 125. Instead, it's just been dribbling lower here, which is bearish, right? We know that this is a very important weekly range, so to not even see the buyers attempt to get it back to that breakdown level, I've got to give the bears the upper hand here. Now, yes, on Friday we did produce a hammer, just like almost everything else out there in the marketplace. So can we see a little bit of a bounce? Sure, it's possible. But on the first initial breakdown, there was no response on that Thursday where the XLV was one of the only green names on the board. So to see that weakness, I'm just not yet convinced that the XLV is going to see a miraculous turn back to the upside and save the day in the market. If it happens, it's got to be a higher low above 125, which we've been harping on and on and on and on about, but as of right now, bearish down here. Continue to look for those targets below us around 119.25. Just be mindful, yes, a hammer did print there, so can we see a little bit of a bounce or a pop or just digestion? It is a possibility. I wouldn't get bearish just yet until there's a clear pattern that would resolve to the downside. So overall, the sectors, I would say, are poised for a dead cat bounce, but nothing is going to be so impressive that structure is immediately going to shift back to the bull side. Here we go in the ratio grid. If you don't know what this is, top right-hand corner is going to tell you what it is and how to set it up here. Top four are the risk-on sectors. And one thing that I've been thinking about is, these, at the end of the day, these, even if everything is red, some will be outperforming, some will be underperforming, so on and so forth. That's just the nature of a ratio. But something to consider here. If everything's outperforming still in the risk-on sectors, you can see that, three, aside from the tech sector, which we know has been in the gutter for a while, if these three suddenly start underperforming to a dramatic degree, what does that look like for the SPY, right? So if these start turning and aggressively heading lower, then, obviously that just continues to build the bearish case here, that even as the market's falling and these things are looking fine, if they turn and start to correlate with the market, then kiss it goodbye, right? These are the heavy weighted sectors. These are what are ultimately going to drive the S&P in one direction versus another. Now, that hasn't happened yet. Let me be clear about that. But it's just a thought on my mind as we're interpreting the ratio grid, right? So as of right now, XLK continues to be the thorn in the side of risk on. XLV looks great. XLF is looking great. Although the structure is bad, right? On a relative basis, XLV is fine. The XLY, a little bit hairy as we start to approach that 50 SMA. That's the gold line. But overall, still in a clear uptrend, right? The risk off sectors at the very bottom are just looking kind of neutral, right? The XLP is sideways, not doing a whole lot down here. The energy sector with that gap down is coming into the 50 SMA. Real estate's starting to get a little bit of a rally off the lows, but still, considerably underneath the 50 SMA. And utilities are still the main concern. So, it's not like we're in a risk-on environment. We've talked about that clearly. I'm just thinking about, if these things start to turn and deteriorate here to the downside and the risk-off sectors start to continue to go sideways or perk up even, like what we're seeing here and here, it's probably not a great look for your S&P 500. So just thoughts on the sectors and their ratio relationships, if you will. Next up, let's take a look at the TNX. And there's something cool I want to tell you about on the TNX. So of course, we can be our funny selves and we can say, number one, the market's like low rates, and number two, the market's like stable rates, which are sideways. Of course, we've done this a million times. This is not stable, and it is also not lower. That goes without saying. But what we do know about this is that the TNX is now starting to compete, or I should say bonds and treasuries are starting to compete with yields that are, 9.26 or 9.2 something is the yield right now on a Series I from the Treasury. So here we go. Series I savings bond, right? 9.62%. So again, this is competing directly with your S&P 500. Why would, think about this, and I'm going to walk through all the possibilities here. Why would someone in the later stage of their investing career not take a fairly safe, big, I want to use quotes around the word safe still, 9.62% yield for at least 6 months compared to trying to time the S&Ps for a reversal back to the upside? So this is in direct competition to the S&Ps. Now, it's not the right investment for everybody. Let me be 100% clear about that. This 9.62 is only guaranteed for 6 months. There are penalties if you withdraw any time before 5 years of holding the bond. There are, you have to hold it for at least a year, and there's a limit. You can only purchase $10,000 of Series I's. So overall, again, this is not for everybody, but this is in competition now for the S&P 500. So to see outflows from the market and moves into bonds, which are going to be your /ZB, right? You can finally see on Friday. Friday is the hammer candle there, by the way. It started to catch a little bit of a bid, right? So don't be surprised if you start to see YouTube videos popping up talking about the Series I bond and the yield that you can get there as a quote-unquote guaranteed 9.62. What they're not going to tell you is that there's a huge opportunity cost, because right off the bat, you lock up your money for a year. Right off the bat, you're taking a penalty if you withdraw anytime sooner than 5 years. What if this is the bottom of the S&P? And I'm not, again, based on all the structure and the sectors so far that we've seen, I'm not arguing that it's the bottom of the S&P, but let's just pretend. What if? You've got a huge opportunity cost if the SPY runs, let's say, 20%. Right? If the SPY runs for 20% and you're locked into this 9.62 or whatever for at least a year, and then it's a variable rate, right? It's going to change after 6 months. What if it drops to like 7 or 6, right? And you just missed out on 20%. So again, I'm not making the argument that the I bond is the best place to be or the worst place to be. It's different for everybody depending on your investment goals, obviously. And I'm not a financial advisor, so I don't know what's right for you and what's wrong for you and your timing and all of that. I just wanted to talk about the idea that there's competition now directly between bonds offering a pretty attractive yield for some and the S&Ps. So if money flows into bonds, then you're not going to get any reaction in the SPY. You're not going to see any significant volume inflows to start to push the market back higher. So that's my interesting rant that I've got for you on the TNX. Hopefully that made sense, but hopefully also, just to tie it back to a directional sort of takeaway for the S&Ps, with these moving higher, with competition in bonds, it doesn't really bode well for the S&P finding a bottom, right? That's the main takeaway from that little rant there. Anyways, what's going on in the VIX? VIX is volatility, of course. We started to see a little bit of an elevation here, which is like, finally, thank goodness. Like, this was not making sense for the longest time. And to see that on, Friday, it's a step in the right direction. But let me just be completely clear here. we're not even close to a capitulation type bottom. We didn't even scratch at 35. The market also didn't really feel like it was, doom and gloom, everything's going to hell in a handbasket on Friday. So to see the VIX elevating a little bit, but not getting that sense of, the world's ending on Friday, then, there could still be quite a bit more pain left in the market before we come in for a quote-unquote capitulation type bottom. Now, have we seen reversals off of moves to this degree in the past? Absolutely. Let me be clear about that as well. You can see these pops in here didn't even make it to where we're at currently, and those produced sort of quote-unquote local bottoms in the S&P 500. So it doesn't mean that we have to get into that 36, 35, 40 handle up here, but I'm just saying that, with volatility the way it is, we could easily continue to see some selling. And that's clear as well on the VVIX, right? The VVIX tracks what people are doing from a hedging perspective, whether or not people are buying SPY puts, VIX calls. And yes, people are actually starting to buy now SPY puts. So a step in the right direction for people being hedged properly. But what this means is that now people are starting to identify the risks in the marketplace and that we could continue to head lower. Right? So although, yes, this is moving in the direction we want it to prevent that sort of flood effect, it still just means that the market is finally recognizing that there are some substantial risks to the downside at this point in time. And this is also clear if we take a look at the VX futures. So these are the volatility futures /VX. There we go. And we look at the trade grid here. All I want to point out is that the October and November months are in backwardation, right? So right here, there is more of a chance that the world comes crashing and burning in the next 24 days than there are in the next 52 days, right? That is absolutely backwards. You would think that the longer time horizon you have, the more of a chance there is for the world to come crashing and burning. So with this backwardation, all I'm pointing out is that, again, the market is starting to finally recognize the risks on the horizon for continued downside. Now, it doesn't guarantee downside, but it does mean that people are starting to position appropriately to hopefully take advantage of, or at least protect from, a downside move. Okay, so hopefully that was not too in the weeds for today's video. If I lost you on that one, I apologize. Let's get into something a little bit more friendly to us, which are the internals. And if you don't know what this is, I've got a video tutorial for you in the top right-hand corner that explains what they are, how to set them up, how they'll help you make better intraday trading decisions. And again, hopefully I don't lose too many people on this. But overall, we're always looking at negative 300 million and positive 300 million to calculate significant inflows or outflows of the market. And obviously on Friday, significant outflow there, just supporting the move to the downside is what I'm getting at. Same thing in the advanced decline line. But the concern here is that everything is correlated to the downside. Everything was sell, 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 sell on the Friday session. So can we see a snapback here? Absolutely. Pair this with the daily hammer candle, with the 100% retracement, with the fact that everybody was short on Friday. If we start to see some rotation, then this could easily produce a snapback in the market. Now, what you want to watch out for is if we stay sideways within Friday's range. So let me zoom in on these futures in the bottom right. If we stay sideways within Friday's range and this neutralizes to 0 on Monday, guess what? We're out of the woods. Overcorrelation has sort of stopped for now. And, that's the most bearish outcome, really, because it's telling us that we're digesting and accepting at these lower prices. If we start to move lower, and this is still continuing to be overcorrelated down here, then all it's going to take is the slightest bullish information, and boom, the rally is going to come, and it's going to hurt a lot of shorts who are late to the party. So be mindful of that. If this is here and we continue lower, we're pushing our luck to the downside. That's what that's the takeaway there. In the tick, just confirming downside, obviously Thursday and Friday, nothing really to read into from that perspective. So those are our internals. Let's take a quick peek at the market profile here. There's one level I want you to pay attention to early on in the upcoming week, and that is going to be in your futures 37.16. 37.16 was the overnight low from Friday morning, and Friday, it's where we have a mechanical high. Notice that we have single print sticking out above. If we breach this level, that is what will likely set off the gap fill, not the high of day from Friday. So for everybody who watched and waited until the market profile right here, you now have an insider tip. Anyone who tuned out early might not catch the same entry as you. So this mechanical level would suggest that if we can take it out, there are probably, high probability that multiple stop losses are placed above. If we take it out, boom, stop run, we move higher, at least to the high of day, and then potentially fill that overhead gap that we just discussed in the S&P 500. So please do be aware of that level right there. The other thing that we typically look at from a market profile standpoint is where value has been developing, and this, of course, is bearish, right? Here's your FOMC day. We confirmed the spike on Thursday, and obviously on Friday, lower value value as well. So from that perspective, yes, bears are in control. But one thing I would point out is how did the auction end at the lows from Friday? What I'm sort of getting at here is that there was a decent volume taper down towards the bottom, right? Now, we technically have only one tick of excess. It's very close to being classified as a poor low, but given the volume taper here, I'm not as concerned with it. It'd be different if we had volume as a bulge down here that produced a poor low, but because there's some taper, to me it would indicate that yes, the auction did actually end quite healthily as opposed to imbalanced down at the lows, all right? So that's the market profile. The main takeaways, again, are just this mechanical level towards the highs, 37.17. 37.17 in your ES is going to be the level that you want to pay attention to for the early entry to move through the single prints and possibly get into the gap overhead if we see some bullish action early on in the upcoming week. Next up, let's go back on over to the platform here and round out the broad market with the QQQ. What's going on the Qs? Drop this back down to a reasonable yearly chart. What do we see here? So certainly the same psychology will apply. I don't want to rehash everything we said about the SPY, but overall, use your gap to be a judge, right? That's going to be 277.81 up to 279.50, and then anything that remains ultimately underneath 286 is just a lower high. Right? Lower high on the daily, lower high on the weekly, and we continue to the downside after that. If we can get price acceptance up above or at or around 286, maybe it sets up for a bullish next week, but hold your horses, one step at a time, right? Certainly, yes, psychology of the hammer, it would imply that maybe we see some dead cat bounce here, 100% retracement, yes. Very, very nuanced. This actually did not come quite as low as the S&P 500, right? So just a small takeaway there. If we do move lower, if we fail off of the gap fill and roll back over, I would watch 273.25, and if that breaks, you're looking for the June low 269.75, some more downside levels that I'll give you right now. If we adjust this chart, we're looking for 261.50. There's really not a whole lot of structure in this general area, so you might want to use the bottom end of the weekly expected move, which is 264.40. I know I didn't put my blue dashed lines. I'll get it next time. Okay, so 264.40 on the QQQ downside. Next up, last but not least, IWM Russell 2000 and the small caps. What's going on over here? Certainly, again, not quite the 100% retracement, a little bit shy of that. Hammer candle, yes. Gap levels are going to be 169.50 up to 171. Anything that closes the gap and rolls over is bearish to the nth degree. We are still going to remain neutrally bearish if we can get acceptance above the gap, but as long as we are underneath 177, remember that the IWM had to play catch up and break down underneath that level, so that's the level. Right, that is it, 177. Anything that remains underneath 177, bears are in control, and we are likely just producing a lower high from the daily and weekly perspective. To the downside, if we just consolidate out and move lower, obviously your June low is 163.25, and the next downside level just beneath the bottom edge of the weekly expected move is 159.25. If you've enjoyed the video so far, give it a thumbs up, hit the subscribe button, all that stuff, and let's get right into Apple here. We'll keep it very brief in the core list. Double bottom, yes. Hammer candle, yes. If we can take out 151.25, look for the retracement back to 154. That's the bottom of this area, the balance range, as well as the breakdown point from the FOMC. If it's downside underneath these equal lows, you've got 147 just underneath, but if that goes, the range definitely opens up into 142.85. Currently with the hammer, I would expect or watch for the bullish outcome first, bearish outcome second. Next up is Netflix. This actually has nothing to do, right? We are inside of the midpoint of this balance range on the daily. We had the look above and fail. We targeted the bottom of the range. We hit it. Now it's patience because we are in the midpoint and there is no easy setup to identify. I would continue to watch 234 and 220 on the downside. Anything that's ping pong in between, not very tradable. Next up is Tesla. What's going on in Tessie? Giving up that 50 SMA, that's the blue line, and also flirting with a larger breakdown of this overall range. We've done it once in the past. Can we hold up here at 267 as a line in the sand? Maybe. As of right now, I would have more of a bearish slant because there's absolutely zero lower wick on the Tesla Friday bar. So anything that rallies, if it does, is going to be very difficult to catch. And instead, I would look to position on shorts for the back test of the 50 SMA and 287.50 in an ideal world. To the downside, if we just continue to dribble lower, I would try to watch for some sort of bounce off of 267 if the broad market is seeing a dead cat bounce in the first place. If the broad market continues to fall apart and does not get this dead cat bounce that we've been talking about, I would not look to buy or get active around that 267. Next up is Google. What's going on in Google? Fill in that downside gap perfectly, giving us a hammer candle on Friday. If it bounces, any rejections off of 101.75 are attractive for downside. The reason we're so aggressive with that first level and not being patient for the 104 is because this big range has broken down. Plenty of potential energy. Remember back to your physics class, right? Plenty of potential energy in this range now needs to be released to the downside. And if we think about range rules, typically what we do is look for a doubling of the range. Here's the range. If we double it to the downside, kind of takes us roughly towards that. What's the level in there? 93. Okay, so basically being more aggressive to the downside in Google because of all of that overhead supply. Next up is Meta. Same idea. If I zoom in, you can see that we've broken down from this range. This one actually is pretty darn close to a range double already, so I'm not sure that I would be pressing the bet to the downside here. The candle is not very clear. It's not offering any insight into what may potentially happen early on in the week. It's just an indecisive doji. Of course, it's more bearish than bullish because it's underneath the 3-day range from in here, the FOMC breakdown. Anything that continues to remain underneath 144, take it as bearish. Breakdowns of the low here can get you closer to 134 on the downside, 128.75 after that. But one step at a time. This chart to me, nothing obvious to do in Meta. Next up is NVIDIA. I would continue to remind you that the highest volume node I have ever seen is basically sitting right underneath us. So I'd be very cautious about big new money shorts to the downside. And I'll show you that weekly high volume node actually right now. Let's just do that. Here we go. There it is, right? So look at this thing. It's absolutely massive compared to all of the volume at price that we have up here. This is basically like do or die time for NVIDIA. Now, granted, that weekly bar is an inverted hammer that is bearish, of course, but if we go back down to the daily, we're actually experiencing quite a bit of indecision. So let me zoom back in on that. Zooming in. So at first it tried to go higher, right? Now it's lower. Now we've got a little bit of a hammer candle. So it's all over the place. If it does want to bounce, again, probably looking to position for shorts up against here as scalps. You're not overstaying your welcome on the downside because of that high volume node I've just outlined on the weekly time frame. If it does move lower, 117.15 is a level, and 108. I would not anticipate 108 being in play this upcoming week. I might eat my words, but so be it. Next up is Microsoft. What do we see going on over here? Just like Meta, this is a little bit more difficult to play just based on the structure that's unfolding. We've got a level clear as day at 241.25. If we can take it out, scalps are on the table only into that 245, and then after that, of course, 248. Those are scalps only. We are not positioned for a big bullish move here. If we put in the higher low above, I would say that right there, 245, then fine, we can change our tone, but currently much more bearish than bullish, so please scalp only on the long side. If we take out the lows or, you position short against this for a rollover, retarget the low, and then after that, we've got 231.50 and 227 as downside numbers. Last but not least, the mini beast. What's going on inside of Amazon? This one's actually, quite far away from the lows of June, which is pretty impressive. Of course, earnings and the gap up did have a lot to do with that, but nonetheless, still hanging in there. Currently, really, really tough to say, right? If you look at this as a range, obviously we're towards the upper third of that. If you look at this as a range, we're kind of in the midpoint of this. The chart structure is very ugly. I would not advocate for chasing new money shorts at this point in time. Obviously, we've broken down already. The time to get short was a break of the 3-day range or a gap fill in here. Now is not the time to get short. So I would be very patient in Amazon and just wait for some sort of structure to build out around 116.50 or 111.60 on the downside. If we're just chopping around inside of Friday's range, not a fan. Nothing to really do. So being patient in Amazon is the name of the game. If you made it to this point in the video, you're a true trooper. Drop me the keyword in the comments section if you know it. If you don't know it, you can probably find it down there. It'll be pretty obvious. But anyways, RIVN is up first on the chopping block because we've got a little bit of a hammer at the equal low / trend line. And this has also been in an uptrend for quite some time now. We did technically make a new higher high from here to here. So the trend line should be buyable in theory. Of course, we want to wait for confirmation over the hammer high and look to retarget the equal highs up here with a stop just underneath the low. Risk reward for you swing traders out there is looking pretty favorable as long as this holds here. Of course, if the broad market's falling apart, this is probably not an attractive trade, right? Next up is KO, and this is actually a short trade. We talked about this as a 1, 2, 3 bar play. It did give us the breakdown, put in a decent range, hammer candle on Friday. So again, looking for a little bit of a bounce, but as long as price remains underneath 59.14, guess what? You can position for shorts against that. Look for the equal low in here. Stop goes just above. As a day trade, as a small swing trade, certainly makes sense from a risk reward perspective. Next up is going to be Snowflake. It is not snowing yet, but it is starting to get cold. Anyways, hammer, not really a hammer, but indecisive doji, I should say, off of triple super support, 50 SMA, support trend line, horizontal level as well. Very similar to RIVN with a uptrend preceding this here. This actually has a slightly lower high. I would start to classify them as equal. So because of that, don't target this area. Instead, if we do get a bounce, be mindful we can produce a lower high off of this prior rejection point around 188, we'll call it for round number's sake, with a tight stop here. Certainly makes sense from a risk reward perspective, as long as the intraday setup makes sense to enter. Next up, we've got ABBV. What's going on with ABBV? A little bit of an inverted head and shoulders start to look, neckline here. If the XLV can perk up, if it can get over 125, that's when I imagine ABBV will be in play. So this is a big if setup, and it's really going to rely on that XLV. If we can take out the neckline here and breach this kind of all of this overhead resistance, really 200 SMA neckline, horizontal level from in here as well. Taking that out and look left, we can travel to the top of this prior range. Let me give you the number. That's 155 roughly as an upside target. Not interested if it just chops around and remains down here. Next up is CL. This is a bear flag in the making, right? If we've got something like this, boom, basically looking for lower here into 74. If you were to look at this on a weekly time frame chart, do something like this, you'll notice it's basically a 3-bar play. You've got your bear bar, you've got an inside doji at the lows, and now you're looking for continued breakdown to, preserve, or not really preserve, but start this trend or continue this trend to the downside. So overall, looking at this as a bear flag on the daily, 1, 2, 3 bar setup on the weekly, a breach of 75 should get us closer to 74. That's just a quick, if you want to do it as a day trade, there you go. But anything underneath that, you can see, we're really just looking at 72.20, so quite a ways to fall if we get the full expected move out of that thing. So that's what I've got for you on this week's video. I know it's a late one. I know it's a long one, so I truly do appreciate anyone who has made it to the very end. Thank you so much for joining us. We will be live at 8:30 tomorrow morning. I wish you all a great trade.